I'm not sure I really want to see silver catching up with gold because, even your most diehard silver bulls will tell you that silver lags gold at first in a bull market and then more than catches up at the end. The best times you could have bought gold during the crash of 2008 and the flash crash of 2020, both of those saw screaming rebounds afterwards. So we might see something like that if the AI bubble bursts. If I'm bullish on gold and I'm bullish on anything real, how can I not be bullish on silver, right? If I'm right in my fundamental analysis and that we still have a long way to go with this market, that argues for actually silver cooling off a bit here. If silver crashes all the way down to 50, the silver miners will still be printing money, like literally. But if we start seeing things going parabolic again and gold confirms silver's move, I would deploy more cash. As crazy as it sounds to say, yeah, I'm going to jump on all-time highs. If people ask me, well, how high can gold go? I always answer, well, how long can governments keep printing money? Demand out of India, front running of tariffs and critical minerals, rebalancing, this sort of thing has put a squeeze on the physical markets. I think that rebalances.
So we've seen this huge pullback in silver and now just kind of a race to the upside again.
Yeah, it's kind of fun when, gold was breaking out and breaking out and breaking out. We had lots of gold headlines and we talked about how that might bring more generalist investors in. It's sort of fun, but also a little bit scary to see silver headlines on CNBC or Bloomberg. There was a video that went around a couple of days ago about, will silver head higher? And it wasn't silver or gold bugs. It was one of these mainstream media outlets. I forget which one. But the funny thing is it didn't tell us anything new, anything we hadn't heard already about the shortage in London of physical and people flying silver around, all that sort of stuff that we've talked about for weeks now. But people got all excited and people wanted to know, what do I think about this video and so on? Well, I think they're telling us what we already know. But to answer the question, I think I have two minds on this. On the one hand, I'm long, and despite people calling me Darth Silver and all these things, I own plenty of silver stocks. I'm very happy to see it long. I've never been a bear. But I have to say, I'm not sure I really want to see silver catching up with gold because, even your most diehard silver bulls will tell you that silver lags gold at first in a bull market and then more than catches up at the end.
Media excitement often misreads market fundamentals. The headlines around silver surges are more noise than signal, repeating known shortages in London and global physical flows without adding insight. CNBC and Bloomberg coverage triggered retail attention, but these mainstream alerts rarely move markets fundamentally. Expert sentiment remains cautious. Owning silver doesn't imply a top is near, but it does underline that investor psychology is inflating minor price shifts. Historical bull markets show silver trailing gold initially, highlighting risk if momentum fuels overenthusiasm. Next, Lobo Tiggre talks why chasing parity with gold could paradoxically signal caution.
It's not the catching up part I have a problem with. It's the end part I have a problem with. My analysis is not technical, it's fundamental, and I don't see any reason for this bull market to end anytime soon. That's like saying the money printing is going to end soon. It just never happens. That said, the bull markets do end despite the money printing. So what I'm saying is, if silver bulls are saying, this is it, silver's finally going to have its day in the sun, it's going to beat gold, be careful what you wish for, because if that's what happens, it means the end of this bull market is nigh.
It is interesting what we've seen over the last, I guess, year and a half or so. I mean, it seems like there are signs here and there that this would be the final blow off top, right? The third stage of the bull market. I mean, one that I look at is the gold silver ratio, and it's below, it was around 80-1 for quite a while, and then it has broken down to about 70-1 now. It doesn't seem like close to where we've seen in the past, but it definitely is falling, which is typically what we see during that blow off top. What do you anticipate if this isn't the end of the bull market within the next few months, maybe year?
Declining gold-silver ratios hint at a market nearing climax. The gold-silver ratio, dropping from 80-1 to 70-1, aligns with historical blow-off top patterns, suggesting silver is beginning to catch gold late in a bull cycle. While fundamentals, continued money printing, signal that the rally could persist, investor euphoria may indicate timing risk. The paradox is clear. Surging silver could reflect bullish momentum, but may also presage the market entering its final expansion stage. Analysts like Lobo Tiggre caution that ratios below 75 often precede correction phases. Next, we'll explore why safe haven metals could remain undervalued even as headlines spike.
What do you anticipate for the metals going forward here?
Well, I'm bullish on anything real that governments can't print. I'm particularly bullish on monetary metals, safe haven assets. If you, dear audience, think that the AI valuations in the market are a bubble, if that bubble pops, I think that would create a lot of demand for safe haven assets. As we all know, if the market actually crashes, I'm not just talking, rolling over and politely, slumping down to more reasonable valuations. If there's an actual crash, everything gets whacked, absolutely everything, including gold at first during that initial liquidity crunch, and then it goes soaring. If that happened for anybody who gets it, that could actually be an absolute gift on the part of the market. That sphincter's opening moment, like in 2020 or 2008. I wasn't in the market in 1987, but I understand it was a similar thing, right? The wrong things go on sale, and that is an absolute, the best times you could have bought gold in my career or during the crash of 2008 and the flash crash of 2020. Both of those saw screaming rebounds afterwards. So we might see something like that if the AI bubble bursts.
AI market froth may trigger a hidden silver surge. If the AI sector faces a sharp correction, liquidity could abruptly pivot to hard assets, echoing the rebounds after 2008 and 2020. Gold and silver could initially drop during the liquidity crunch, but then accelerate, creating opportunity for patient investors. Real money metals act as shock absorbers when equities overheat. Lobo Tiggre highlights that previous systemic shocks rewarded buyers who held during panic, reinforcing that timing and composure outweigh headline-driven decisions. And what follows next may redefine safe haven positioning in a post-bubble market.
And if not, broadly speaking, I think the writing is on the wall of the inflationary agenda in the United States. Even if you agree with Trump, the Doge did not save us $2 trillion. The tariffs are being walked back and negotiated down. So I think the agenda is highly inflationary. Europe's rearmament is highly inflationary. Russia's war is highly inflationary. Even China, at long last, has finally got some consumer price inflation going again. So, that's bullish for monetary metals. And then to sort of the not just the geopolitical risk, but the awareness of how rickety the financial house of cards has gotten. I think, I can't prove this, but I think it has a lot of mainstream investors, deep-pocketed, not just institutions, but individuals, family offices, that sort of thing, saying, maybe I should hedge with a bit of gold and maybe some silver too. So all of this is very bullish, whatever happens long term. And I feel a bit odd saying this when we're at or near record prices in gold and silver, but there's actually not a very strong case for gold going down. The strongest case we could have made recently was, gold went screaming up to 4,400.
Inflation pressures are converging globally and quietly boosting metals. U.S. fiscal measures, Europe's military spending, Russia's ongoing conflict, and China's rising CPI create a multi-front inflationary environment. These pressures directly support gold and silver valuations, reinforcing demand for monetary metals as hedges. Deep-pocketed family offices and institutions are repositioning quietly, beyond the public eye, responding to systemic fragility. While record gold prices seem stretched, historical trends show that sustained inflation typically drives further gains, underscoring undervalued potential in these assets. Next, Lobo Tiggre examines why silver may follow gold even if headlines exaggerate its short-term volatility.
That was too fast, and it has to be a correction. And then the question was, would that be a peak or would it be a plateau to another high later? And I wanted it to be a plateau, but Mr. Market doesn't care what I want, right? So we had to see. And I think it's pretty evident right now. It certainly wasn't this kind of peak. It wasn't a 1980 intraday type peak. it looks like 4,000 is the new 3,000, and we're consolidating before moving higher. So overall, bullish, bullish, bullish all around. It's a crazy thing for me to say at these levels, but that's the way I see it. And sorry, let me come back to the point of your question. If I'm bullish on gold and I'm bullish on anything real, how can I not be bullish on silver, right? That having been said, if I'm right in my fundamental analysis and that we still have a long way to go with this market, then that argues for actually silver cooling off a bit here. Maybe it kisses 60, that sparks some profit taking and it cascades a bit. But if silver crashes all the way down to 50, the silver miners will still be printing money, like literally pulling money out of the ground, real money. So I don't think that would be a disaster at all.
What looks like frothy prices may actually be a controlled consolidation. Gold at $4,000 isn't the peak some fear. Comparing it to 1980 intraday highs misleads casual investors. Silver could flirt with $60, triggering profit-taking without derailing fundamentals. Miners continue to generate real cash even if silver's to $50, providing portfolio resilience. Historical trends from prior bull markets show that temporary pullbacks often precede stronger, sustained gains. Investors need to differentiate headline volatility from structural risk. Next, Lobo Tiggre explore how physical supply and global demand pressures could further shape silver's trajectory.
I think to the degree that something like that put the silver stocks on sale, again, that would be an opportunity. And what might make that happen? If it's true that, demand out of India is and front running of tariffs and critical minerals rebalancing, this sort of thing, has put a squeeze on the physical markets, I think that rebalances. And again, I'm not a bear here. I'm not arguing against silver, but I think that would be a good thing. That would set the stage again for consolidation before moving higher. And if that's not what happens, if we're really at that blow-off top, the good news is, okay, everything will go higher. The bad news is that whenever it, peaks, that we're likely then to go into bear mode for some time. So yeah, again, Mr. Market doesn't care what I want. I would prefer it wasn't the blow-off top just yet. But if it is, if we start seeing things going parabolic again and gold confirms silver's move, then actually I would deploy more cash. As crazy as it sounds to say, yeah, I'm going to jump on all-time highs, if we're looking at that blow-off top, then yes, I would put more money to work trying to profit on that.
Temporary dislocations in silver stocks can create strategic buying windows. Physical market pressures, especially from India's demand and tariff-driven front-running, may briefly depress silver stock prices, offering selective entry points. Historical consolidation phases, followed by confirmation from gold trends, suggest that a disciplined approach can capture upside even near all-time highs. Investors must weigh the probability of a blow-off top against ongoing global liquidity trends. Experts note that measured deployment during parabolic moves can outperform passive accumulation strategies. Next, Lobo Tiggre talks how macro signals like Fed speculation influence short-term silver momentum.
And I mean in the stocks. Bullion, I always buy on the dips. That's my savings. I'm always willing to accumulate bullion. That's not what I'm talking about. I'm talking about, speculating for hockey stick gains on the stocks.
How much of what's happening right now, maybe in the last couple of weeks, do you attribute to, it seems like a Fed rate cut is now more likely. It was questionable for a couple of weeks there, but now the betting markets are really saying that, we're going to get a Fed rate cut most likely in December. And also, it seemed like this leak about it's Kevin Hassett, who is likely to be the next Fed chairman. Betting markets have him over 80% chance of being the next Fed chairman. How much of that, with respect to the Fed and Trump and everything, is what's fueling the push, especially for silver higher?
I got a yes and no on that. Clearly when those things happen, the headline about Hassett came across, we saw an instant response in the markets, the broader markets, as well as gold. I don't remember silver wiggle that day, but I do remember that it was good for gold that day. And I think silver was sympathetic.
Fed chatter moves headlines more than fundamentals in the short term. Betting markets pricing in a December rate cut and Kevin Hassett's rumored Fed chairmanship temporarily boosted gold and silver sentiment. But these reactions are often ephemeral. Real market fundamentals, such as physical supply and monetary policy trends, have far greater impact than transient speculation. Retail investors chasing these headline moves risk mistiming entries. As noted by Lobo Tiggre, sympathetic moves in silver reflect broader macro sentiment, not lasting structural shifts. Next, we'll discuss why the Fed's predictable actions often fail to create sustainable market momentum.
But then things go back to the way they were. And at this point, that Fed rate hike, as you say, that the market's in near certainty, that's priced in. There may be a small move on the day of, but as we've seen, when this happens, when the Fed does exactly what's expected, the FOMC release comes out and nothing happens. It's when Powell exercises his jawbone that things can happen. That's harder to price in, and more question marks about well, is Powell? He's on his way out. Is he gonna capitulate and just go more dovish because he's on his way out anyway, or is he on his way out so he's gonna just tell Trump to stick it where the sun don't shine and just double down on his obstinacy? I don't know. I don't know how you handicap that. Maybe Kelshi or Predicted or one of these places will have some sense of that, but that's just people's accumulated guesses. I don't know. Answer to the question is, I think these things are marginal. The debasement trade, and I think it's hilarious that Wall Street has suddenly discovered the debasement trade. We've been talking about this since 1971, but that is gold bugs. But that is a real thing, and it's durable, and it's irreversible.
Wall Street suddenly celebrates a trade experts have known for decades. The debasement trade, long discussed by gold analysts since 1971, has been overlooked by mainstream institutional investors until recently. Market responses to predictable Fed moves are muted. Real volatility arises when unexpected policy jawboning occurs. Powell's impending exit adds ambiguity, but fundamentals of currency debasement and monetary inflation remain unchanged. Investors relying solely on Fed headlines risk misjudging durable trends that have driven gold appreciation for over 50 years. Next, we'll explore why understanding structural money printing dynamics is crucial for positioning in precious metals.
If people ask me, well, how high can gold go? I always answer, well, how long can governments keep printing money? Where is the end of that process? So if you're not worried about the shorter term fluctuations, and by the way, if you bought the very peak, if you just had the bad luck to jump on the bandwagon or listen to some evil scum of the earth newsletter writer who says he's going to buy the all-time high, right? If you did that in 2011 and you bought gold at the very top in 2011, you would have more than double your money now. Okay, it took 14 years, but it happened, right? So if you pull back and look at the big picture, if that's your basis for action, I really don't think you have all that much to worry about. And of course, almost nobody top ticks a market. Most people have done better. And if people had courage of their convictions and they bought the slumps, they bought down in 2015 near the bottom, then they would have made much, much more than just double their money. So, the good news here, I think, is that for hard money advocates, liberty and finance audience types, what's going on in the real world out there.
Gold's long-term trajectory is defined more by systemic money printing than by short-term market swings. Even if you bought at the 2011 peak, patience turned that decision into a more than 2x gain over 14 years, illustrating how enduring fundamentals outlast market timing anxiety. Those who bought during slumps, like 2015, captured significantly higher returns, emphasizing disciplined accumulation over headline-driven panic. For serious investors, this underscores the durability of gold as a store of value amid ongoing fiscal expansion and monetary policy noise. Historical perspective matters more than chasing highs. Next, we'll examine why disciplined patience can outperform reactive trading in any market environment.
And if you're patient, you stay the trades, you buy low, sell high, you can do that repeatedly and make a bunch of money. If you're not in the money-making phase of your life, you're in the wealth preservation phase of your life, then, don't lose the faith, brothers and sisters. Your real money is what it is, and we all know, whatever the Fed may or may not do, those 25 basis points or not, that's not even icing on the cake. That's just superfluous almost. small-time noise.
Investors often overreact to incremental Fed moves while missing the bigger picture. Whether in wealth accumulation or preservation, the real strategy is discipline. Buy undervalued assets, sell when appropriate, and repeat. Minor rate changes like 25 basis points are virtually inconsequential relative to structural factors like long-term inflation trends and fiscal policy. Analysts note that treating these small adjustments as market-moving events misguides retail investors and fuels unnecessary panic. True portfolio resilience comes from focusing on underlying asset quality rather than transient headline shifts.